Welcome to the third video of our Technical Analysis Premium course. If you haven't seen the first two lessons yet, I highly recommend watching them first, as each video builds on the previous one. Especially the first one, which I spoke about why you are still losing in trading and what new approaches you will gain here to ensure you don't repeat your past mistakes. Now, let's take a closer look at how the price or the value of a coin or stock actually changes in the markets we trade. Let's go step by step and see what drives these movements and how the price reached to overbought, oversold levels. Further, we'll discuss what kind of behavior the price action will have when it reaches these overbought, oversold levels. Doesn't matter whether it's crypto, forex, or any other assets, price action works the same across all the markets. So let's dive into more detail. Now, I have a question for you. What causes the price to go up and down? Look at this chart. Over here, price gone up, and it's going down from this point. What are the reasons for the price to behave like this? What really causes the price to change? Its value in this way. That fundamental principle we called supply and demand. That is very simple in terms, and that is what we learnt in schools when we did our economics subject. Even in this world of trading, we're often told that prices move because of supply and demand, whether in forex, cryptos, or stocks. But is that really true? I'd argue it's not that simple. If it happens because of supply and demand, then these markets would become a holy grail for us. If that is the case, we can make millions from this. But is it really that easy to do? No, these markets' behavior is different. Anyhow, we are learning the theory and basics behind these so that real market behavior and the secrets of these markets are something I'm going to cover later on with a totally separate video lessons. First, we'll talk how everybody teach about it. Okay, let's take Bitcoin as a simple example. If the demand of the Bitcoin is way higher than the supply of it, the normal scenario is price will rise up or the value of the Bitcoin should go up. This is what we learnt in economics, and that is the basic scenario. It has been a long time since people started collecting Bitcoin and save it in their digital wallets. So the amount of Bitcoin available to trade on the spot market has been going down drastically during past few years. Because of that, we can say the value is going up. Let's say there is a way higher supply available than the required demand of any item. In other words, more people are ready to sell a certain item, and there is very less demand available in the market. What will happen? The price should go down or value will decrease. What if the supply and demand is same for a certain item? In other words, when buyers and sellers' requirements are roughly balanced, the price doesn't move much. Instead, it stays within a relatively stable zone. Now in these markets, we know that we have both buyers and sellers. In normal retail markets, we buy things to consume in our normal life. We might not use them for a longer time, and we consume them within a short period. In financial markets, we often buy coins or stocks and hold them for a longer period, waiting for the price to rise, then sell at a higher value to make a profit. Just like with stocks or cryptos, it's common for people to hold them for a long time. Now, because of that reason, buyers and sellers have a competition in these markets. Not even with buyers and sellers. Even buyers and buyers have a competition to buy stocks or cryptos for a lower value than others. Same scenario for the sellers. They have a competition within the sellers themselves to sell the stocks at a higher price. I hope this makes sense and you understand what I'm explaining here. Let's talk about this scenario in more detail. Now let's say sellers are demanding $225 for a stock, but buyers are not ready to pay that much, they just want to pay $200. So what will happen? There is no deal because there is no agreed price for this stock. Let's say sellers are demanding $200 now. Then what will happen? A transaction will be made because both parties has come to an agreed price. Let's say sellers are asking different prices now, starting at $200 and going higher. What if buyers are happy to accept all these prices? They will buy at $200, they will buy at $205, they will buy at $210. Like that, whatever the price asked by the sellers, buyers are ready to buy them all now. What could happen to the price of this item or the value of this stock? It will go up, because it doesn't matter about the supply. and asking price of the sellers. The demand is there from the buyers, and they are ready to take them over regardless of the asking price. So in that case, price will go up, and we say buyers have the control over the market. Or we can say buying pressure is higher than the selling pressure. It is the same other way around. For any reason, if the sellers are ready to sell the stocks for whatever the price is asked by the buyers, then price will go down. Let's say buyers are waiting to buy at $200, $190, $180, and downwards, and sellers are ready to sell at all those prices. Then the value of that stock will go down, and we say sellers have control of the market. Or in other words, selling pressure is higher than the buying pressure. So when the buyers have control over the market, and when they push this price upwards, there is a situation where buyers will give up eventually. Because buyers have already bought this coin for whatever the asking price is by the sellers, it has gone up and reached to higher value. Now it's not worth for them to buy this asset anymore because it's already overpriced. This kind of situation we call price has reached to an overbought level, or the area where buyers doesn't have any more interest to take action. It is same the other way around. If the prices has reached to a certain level where sellers are not ready to sell. Now they sold at all the prices which asked by the buyers. It has reached to a very low value. It is not worth for them to sell any more further because it has reached to a very cheap price. In that case, we call price has reached to an oversold level. Now let's talk about what will happen when price reached to these overbought and oversold areas. Two scenarios can happen in both these oversold and overbought cases. First is price might pose or rotate around that certain price region. Now buyers or sellers, they are tired and exhausted because price has reached a level where they don't have any more interest to buy or sell. They are not comfortable in buying or selling anymore. So the price will pose or rotate in a certain price region. We call it consolidation or rotation of the price action. The second scenario happens around the overbought and oversold area is price might fall down from the overbought area, or price might start a rally up from the oversold area. I've mentioned two possible scenarios that can occur when the price reaches an overbought or oversold level. Let's discuss these two scenarios in more detail. First, we'll look at consolidation or rotation scenarios. This is the Bitcoin chart 1 hour time frame. You can see the price has dropped from $114,000 to around $109,000. After that price movement, you can see prices started rotating around this price region, or it has consolidated around the zone, which I marked with these two green lines. Because it's at an oversold level, sellers don't want to sell any more Bitcoin, and buyers aren't too eager to buy at that price either. Or we can say, buyers had some uncertainty towards buying Bitcoin for that price. So it's an example of price doing a consolidation, and we can see this kind of consolidations on all time frames. We might see small consolidations on small time frames and more longer consolidations on longer time frames. Since this is 1 hour chart, you can see this consolidation happened nearly 2 days and 20 hours. If we go to weekly time frame on Bitcoin, you can see this movement here. Price has dropped from $64,000 to $30,000. Not sure if you remember this. It happened around pre-COVID-19 period in 2021. So after hitting $30,000, area price has started a consolidation around $30,000 and $40,000 because Bitcoin value dropped more than 50% after making a new all-time high. So it has reached to a well oversold area, and since then it had been rotated for more than 2 months until it broken that $40,000 level again. So depends on time frame, we can see different consolidations like this on all the assets we trade on these financial markets. Let's go to a smaller time frame. This is Apple stock 15 minutes chart. Price has had bull trend until it reached this 240 area. After that, it has started a consolidation. You can see it has consolidated around 2 days. So what we can understand is buyers are not interested to buy anymore, and sellers are not interested to sell either. Now, what can happen after a certain period of consolidation or rotation? We can expect a breakout of that level again and continue the same previous trend. Or we can expect a price reversal. Look at this example. Price has done a breakout and started the bullish trend again. Even it could have started a reversal from this area. Both these scenarios can happen over here, and it all depends on how much money which comes towards these markets during that time. Around these consolidation zones, traders often draw a variety of different patterns. By now, you've probably seen them or even used them in your own trades. But let me ask you, have they really brought you consistent profits? Have you become a profitable trader by relying on them? Leave me a comment if you have. People call them rectangles, ascending triangles, descending triangles, bull flags, bear flags, so many things. We'll cover all these patterns in future videos, and after that, I'll show you how market makers actually use those drawings to trick traders and hunt their hard-earned money. We will talk about rotation patterns more detailed in the future. I'll explain what actually happens during these phases and how market makers use them to hunt stops and trap traders. So let's get back to the main topic again. The second scenario happens at overbought and oversold levels. Look at this example. This is the gold chart, 5 minutes time frame. We can see a good buying pressure and gradually decreased around this area. Suddenly, it started falling down. So it reached to an overbought level, and sellers jumped into action straight away. Same here, price reached to a level where buyers are not interested anymore, and then gradually value started going down. So this thing happens again and again on stocks and cryptos. This is the basic theory we are discussing here, and with Forex, the story is a bit different. Anyhow, I will do a separate video for that later on. And the other thing you have to understand here is there are no proper structures or mandatory patterns on these charts. The same candlestick pattern which created here will not happen the same way again on the next time. Every candle which made over here have taken those shapes because of the money which came during those 5 minutes. We never know what kind of money will come during next 5 minutes. So if you're a beginner, it's crucial to understand these scenarios clearly. Price action will not behave the same way every time it reaches to an overbought and oversold levels. You might be wondering, why is it so important for us to pay attention to these small, simple details? Because they're what help us truly understand how the market moves. What is our primary purpose at the end of the day? Execute a trade and make some money, isn't it? Why we look at these candlesticks? Because the behavior or the competition between buyers and sellers can be recognized by looking at these candlestick charts patterns. That is what we use to take a trade. Reading the situation, analyzing the market, helps us to take that decision. From where to enter a trade, from where we should go out of it. So that's why you need to understand these things as beginner. Candlestick charts we come across these markets has many different types of candlesticks, many different shapes, many different types of wave patterns, and they all represent the game which happening behind these buyers and sellers. The fight happening behind the scenes. Making profits or taking losses depends on how good you are in reading these situations. Your decisions really matters here, because within a minute, you might lose all you got in your pocket. Very few seconds is more than enough to wipe off all of your life savings. It might already happen to you before. If you are a newbie for this trading, you better prepare for that in future. So be careful. To avoid losses, your first goal must be to become a good reader of these markets. Don't just go and jump into trades after watching these videos. I'll be teaching you the hidden secrets behind these patterns and the real truths about these markets. Before we get there, we need to cover the basics, and it cannot be done within a video or two. It has to be a step-by-step process. Once we learn all the basics, then we can start discussing what really happens behind these markets. If you want to learn trading from zero, this is the channel you want to be with. You will find powerful lessons which covers all the aspects about trading. Doesn't matter whether it is crypto, Forex, or any other financial market. And very important content regarding trading psychology, helping you build the right mindset to handle whatever challenges the future brings, or how you can overcome the failures you already done in your past. Trading is all about a mind game. If you don't learn to control your mind, there's no way you'll succeed as a trader. please do not forget to check my other videos. Leave a comment to share your thoughts and subscribe to the channel. Trust me, you won't regret it down the road. Good luck, everyone.